If I told you that 95% of retail traders are playing a rigged game, but there's a way to join the winning side? Welcome back to the course. And today we're diving into smart money concepts, the methodology that lets you trade alongside banks and institutions instead of being their exit liquidity. By the end of this video, you'll understand exactly how institutional traders move markets and how you can follow their footprints to profitable trades. Let's get into it. Section 1. What is smart money concept? So what exactly is smart money concept? Simply put, SMC is a trading methodology that focuses on understanding and following the footprints of institutional traders. We're talking banks, hedge funds, and market makers. Here's the game changer. If you can identify where institutions are entering the market, you can enter alongside them and profit from their massive order flow. Think about it like this. If you knew that a billionaire investor was about to buy $100 million worth of Apple stock tomorrow, wouldn't you want to buy today and ride that wave? That's exactly what SMC teaches you to do. Instead of relying on lagging indicators, SMC focuses on 5 key concepts: liquidity, where are the stop losses clustered; market structure, the framework of highs and lows; order blocks, price zones where institutions place massive orders; fair value gaps, imbalances institutions like to fill manipulation; how prices move to trigger retail stops. Here's a perfect analogy. Imagine a real estate developer wants to buy 100 properties in a neighborhood. If they start buying openly, prices skyrocket. Instead, they spread negative rumors about the area. Wait for panicked sellers to list cheap. Quietly buy everything at a discount. Then announce a major development project. Prices soar, they profit. This is exactly what happens in the markets every single day. SMC teaches you to recognize these patterns. Section 2. Why SMC works everywhere. Now you might be wondering, does this work on my market? The answer is yes. Whether you trade forex, crypto, or indices. Why? Because all markets operate on the same fundamental principle. Large players need liquidity. Whether it's a bank buying euros, a whale accumulating Bitcoin, or a hedge fund shorting the S&P 500, they all face the same challenge: finding enough counterparty orders to fill their massive positions without moving price against themselves. This universal need creates universal patterns. Forex. Before a Federal Reserve announcement, institutions already know the likely outcome. They position early, manipulate price to grab liquidity, then profit when the news surprises retail traders. Crypto. Bitcoin sits at $88,000 with obvious support. Whales push it to $76,000, triggering millions in liquidations, accumulate during the panic, then pump it to $120,000. Indices. S&P 500 sweeps below yesterday's low at 9:29 a.m., triggering early stops, then rockets higher at the 9:30 market open as institutions fill buy orders using that stop-loss liquidity. Notice the pattern? Obvious level with stops, price sweeps the level. Institutions fill orders. Price reverses. Section 3. The 4-phase smart money cycle. Understanding the smart money cycle is absolutely crucial. Markets move in 4 repeating phases, driven by institutional behavior. Phase 1. Accumulation. This is when institutions are quietly buying while retail is selling or sitting on the sidelines. The price action is boring, ranging, low volatility. Retail loses interest. How do you spot it? Look for price consolidating after a decline, with multiple failed breakdowns below support. That's institutions grabbing liquidity while accumulating. Phase 2. Manipulation. This is the trap, the final liquidity grab before the real move. Price makes a false move, breaking below support for a bullish reversal or above resistance for a bearish reversal. Retail enters on the wrong side, and then, boom, rapid reversal. This is maximum pain before maximum gain. Phase 3. Distribution. Now the real move happens, strong directional movement. And this is when retail finally notices and jumps in. But they're late to the party. For a bullish cycle, price trends higher and retail buys breakouts while institutions are selling into the enthusiasm. For a bearish cycle, price trends lower in retail shorts while institutions are buying the panic. Phase 4, redistribution. Institutions have exited. Price gets choppy, false breakouts in both directions. Retail holds their positions expecting continuation, but the market is preparing to reverse into a new cycle. This cycle repeats because institutions need liquidity. Your job as an SMC trader? Always ask yourself, where are we in this cycle right now? Section 4, SMC versus retail strategies. Let's talk about why most retail strategies fail and how SMC is different. Retail traders use RSI, MACD, moving averages, waiting for oversold signals. The problem? Indicators, LAG. They show what already happened. Everyone sees the same signals, so there's no edge. RSI hits 30, retail buys. Price keeps dropping to 20, then 10. Retail gets stopped out. Then price bounces without them. Retail draws horizontal lines and assumes they'll hold. But here's the truth. Obvious levels are exactly where institutions' hunt stops. Support holds 3 times at 1.0800. Retail places buy orders there. Price spikes to 1.0780, triggers all the stops, then bounces. Retail missed it again. Retail waits for breakouts above resistance, enters expecting continuation, places stops below the breakout. And most breakouts are false. They're manipulation. Retail becomes exit liquidity for institutions. The SMC difference. SMC traders focus on liquidity. We identify where stops cluster, wait for liquidity to be grabbed, then enter after manipulation. We analyze structure, understanding when trends are intact versus changing. Not subjective lines, but objective frameworks. We trade order blocks, zones where institutions place large orders. We enter where they have interest, and most importantly, we're manipulation aware. We expect false moves. We don't trade initial breakouts. We wait for the trap to complete, then enter. Let me break this down. Retail focuses on indicators and patterns. SMC focuses on liquidity and structure. Retail enters at breakouts. SMC enters after manipulation. Retail win rate 30 to 40%. SMC win rate 50 to 65%. Retail poor risk-reward ratios. SMC excellent 1 to 3 or better ratios. The difference? SMC gives you an edge based on institutional behavior. All right, let's wrap this up with the key takeaways. 1. Smart money concepts is about following institutional order flow, not lagging indicators. 2. SMC works across all markets, forex, crypto, indices, because liquidity dynamics are universal. 3. Markets move in 4 phases: accumulation, manipulation, distribution, and redistribution. Know where you are in the cycle. 4. The biggest difference between SMC and retail? We trade after manipulation, not during it. We position ourselves with institutions, not against them. Here's the bottom line. Institutions leave footprints, liquidity grabs, structure breaks, order blocks. Your job is to read these footprints and follow the money. This isn't magic. It's not a get-rich-quick scheme. It's a logical framework based on how markets actually work. In the next module, we're going to dive deep into liquidity, the foundation of everything. You'll learn exactly how to identify liquidity pools and how institutions engineer price to grab them. If you found this valuable, smash that like button and subscribe for the rest of the series. Drop a comment below telling me which market you trade, forex, crypto, or indices. And if you want the full course materials, check the link in the description. Remember, the market isn't random, it's engineered. And now you know how the game is really played. I'll see you in Module 3.